It's 6 in the morning. Over on the east side of town, Ryan is already awake. The glow of two monitors lights up a dark room. His coffee is going cold next to his mechanical keyboard. One hand on the mouse, hunting for the perfect setup, the one trade that's going to change his life. Across town, Sam is asleep. And here is the weirdest part of this entire story. Sam is the one who is going to win. Ryan is about to work harder at building wealth than almost anyone you know. He's going to learn every candlestick pattern. He'll memorize the MACD, the RSI, the Bollinger Bands. He'll pour thousands of hours into those glowing screens. And the math? The math is quietly betting against him the entire time. Sam, on the other hand, is going to do almost nothing, and he is the absolute favorite to win. And I have spent an unreasonable amount of time watching people confuse being busy with getting ahead. Every single day, we are fed this narrative, hustle culture, the grind, the 4 a.m. wake-ups. We are told that if you put in the hours, you get the results. But the stock market is a strange, twisted beast. It doesn't care about your sweat equity. Today, we're running the exact numbers on day trading versus passive index fund investing. We're going to track two identical guys over a 20-year span, and the gap at the finish line is going to completely blow your mind. Grab a coffee, settle in. Let's look at why activity is loud, progress is silent, and why you might just be donating your money to strangers. The starting line. Let's keep this completely honest, because these financial comparisons on YouTube are usually rigged. Ryan and Sam are both 28 years old. They both make $55,000 a year at their day jobs. They both have managed to save up exactly $30,000. They live in the same city, pay the same rent, and are starting at the exact same financial starting line. The only thing that is different is what they decide to do with that 30 grand, and, more importantly, what they do with their evenings. Ryan hops online and reads that day trading is how ordinary people escape the 9-to-5 matrix. So he takes his $30,000. He drops $1,500 on a trading course from a guy standing in front of a rented Lamborghini. He sets up his monitors, funds his brokerage account, and starts trading. Before work, during his lunch break, late into the night. Sam reads an article by Warren Buffett that says almost nobody beats the market. He shrugs, opens a brokerage account, and drops his $30,000 into a total market index fund, like the S&P 500. He sets up an automatic $200 deposit to go into the account every single month, and then he basically forgets the account exists. On day one, these two lives could not look more radically different. Ryan has an entire command center. He's got a watch list, a trade journal, and he's in a Discord server full of guys putting rocket emojis next to ticker symbols. When his friends at the bar ask what he's up to, Ryan gets to say, "I trade." People lean in. It sounds sophisticated. And every time he closes a trade in the green, his app throws a little burst of digital confetti across the screen. Something in his brain lights up like a slot machine paying out. Sam? Sam has an automated confirmation email. When his friends ask what he invests in, he says, "An index fund." Their eyes glaze over. It's boring. There are no rocket emojis for "I bought the entire U.S. economy and took a nap." Here is the trap. Ryan's path feels like winning. Sam's path feels like giving up. But the market doesn't pay you for effort. It pays you for edge, and it charges rent on activity. Year 1 and the illusion of genius. Let's start the clock. Year 1. I have to be completely fair here, because year 1 is where Ryan's story looks incredible. The market goes on a little bull run. A few tech stocks go crazy, and Ryan catches the wave. By spring, his $30,000 has grown to $48,000, maybe even $40,000. He's crushing it. He's beating Sam. He's beating the market. He screenshots a massive $1,200 Green Day and drops it in his group chat. For a few glorious months, Ryan is living proof that everybody who doubted him was a fool. Meanwhile, Sam's account has crept from 30,000 to about 35,000. It's just the market slowly drifting upwards, plus his boring $200 monthly deposit stacking up. If you froze the tape right here, you would swear Ryan is the genius. This is the exact moment that course sellers take screenshots of. This is the "I quit my job at 28" YouTube thumbnail. It feels real. But here's the problem with the stock market. A coin that lands heads 5 times in a row feels like skill, too. The traders who win early are actually in the absolute worst danger because the market just taught them the wrong lesson at the worst possible time. It taught them that their luck was actually their genius. Year 3 and the brutal math of losing. By year 3, the coin stops landing on heads. The hot streak reverts to the mean because hot streaks always revert to the mean. Ryan hits a brutal stretch. The market goes sideways, and his beloved tech stocks start chopping him up. This leads to something traders call revenge trading. It works exactly as well as it sounds. There was one Tuesday in March that Ryan will never forget. He was down $400 by lunch. Instead of walking away, he doubled his position size to win it back fast. He sat there, hand frozen on the mouse, watching the stock fall straight through the floor. He was speaking out loud to an empty room. "Come on, it has to bounce. Just bounce to break even." It did not bounce. That one afternoon cost him $1,100 and a full week of sleep. The worst part, he knew he was breaking his own risk management rules, and he did it anyway. So after 3 years of grueling full-time effort, Ryan's $30,000 is worth roughly $30,000. Actually, once you count the $1,500 course and the expensive mistakes, he's probably slightly down. Sam, meanwhile, hasn't checked his app in 11 months. When he finally logs in, his account is sitting around $48,000. By any honest accounting, Sam has been completely checked out of the financial world, and he is now $18,000 ahead of the guy treating it like a second job. Now, you might be thinking, well, Ryan just got unlucky. Or Ryan is just bad at trading. No, Ryan isn't unlucky. Ryan is perfectly mathematically normal. Let's look at the actual data because it is terrifying. The Brazil study. Researchers tracked everyone who started day trading futures over a 3-year window. Of the people who stuck with it past 300 days, the committed ones, 97% lost money. Not underperformed the market, lost money. Only 1 in 100 made more than minimum wage. The Taiwan study. Economists pulled the complete records of an entire stock exchange over 14 years. They found that fewer than 1% of day traders could reliably earn a profit after trading cost. The U.S. data. The most active retail traders underperformed the market by around 6.5% a year, every single year. When Ryan ends year 3 exactly where he started, he didn't fail. He achieved the median outcome. The hidden costs, the spread, and taxes. Why is the data so brutal? Because the activity itself is the thing bleeding you dry. Let's talk about the invisible assassins of wealth. First, the spread and the machines. Every time you trade, there is a tiny gap between the buy price and the sell price. Pay it once, no big deal. Pay it thousands of times a year, it's a massive drag. Furthermore, you are trading against multi-million-dollar algorithms and high-frequency trading machines. They see the price move and act before the light from your monitor has even reached your retinas. You are playing a video game on extreme difficulty against the developers. Second, taxes. This one makes me sick to my stomach. Let's pretend Ryan is actually in that top 1% and he has a winning year. Let's say he nets $20,000. Because he held those stocks for less than a year, the government categorizes that as a short-term capital gain. That gets taxed like ordinary income, usually 22% to 24% plus state taxes. When Sam finally sells years now, it's a long-term capital gain, taxed at a much lower rate, often 15%. Even better, Sam isn't paying a dime until he sells. His money compounds untouched for decades.
Ryan's pile gets aggressively chopped down every April, destroying his ability to compound his wealth.
Third, and most importantly, time. Let's count the hours. Ryan trades and researches 30 to 40 hours a week. Call it 2,000 hours a year. Over 5 years, that is 10,000 hours of his one and only life spent staring at glowing rectangles. Sam spent 1 hour total setting up his automatic deposit in year 1. Measured by the hour, Sam is quietly the highest paid person in this entire scenario, and he was literally asleep or on vacation for most of it. The pros can't beat it either. Now, a day trader watching this video right now is currently screaming at their screen. They have a fair objection. Sure, most amateurs lose, but the best ones win. Skill is real. And yes, skill exists. But here is the problem with betting your life savings on being the exception. Let's ignore the guys in their bedrooms. Let's look at the absolute peak of Wall Street. Professionals with Bloomberg terminals, Ivy League PhDs in math, and limitless research budgets. Every year, a scorecard called SPIVA checks to see how many of these Wall Street pros beat a simple index fund. Over a 20-year timeline, about 92% of professional active fund managers lose to the index. If you want it even blunter, Warren Buffett once made a famous $1 million bet. He bet that a plain, boring S&P 500 index fund would beat a hand-picked basket of elite, expensive hedge funds over a 10-year period. He won so decisively that the hedge fund guys conceded the bet early. The index returned about 7% a year. The brilliant, high-stress hedge funds returned about 2% after their massive fees. So when Ryan tells himself he is going to be the exception, he needs to realize who he is competing against. He isn't competing with his friends. He is competing with Wall Street algorithms and losing to the exact same index fund that the Wall Street pros are losing to. The heroic act of doing nothing. Now, I need to flip the script for a second, because I don't want to make index investing sound like some magical risk-free utopia. It is not. The market is absolutely brutal to sit through. Let's rewind to 2008. The fund Sam's money is parked in dropped 37%. More than a third of his hard-earned wealth vanished into thin air in a matter of months. Think back to early 2020. The market fell almost that fast in a matter of weeks. Sam felt the panic too. During that crash, he opened his investment app for the first time in months. He saw the massive red number. He sat there on his couch with his thumb hovering over the sell button. Every human instinct in his primal brain was screaming at him, "Get out! Stop the bleeding! Sell it all!" But he didn't press it. He closed the app. That right there, that is the entire heroic act. A guy sitting on a couch consciously choosing not to press a button. That one decision of inaction was worth more than every trade Ryan ever executed. The index only pays you its historical average if you actually stay in your seat. And the truth is, most people can't. Study after study shows that the average index investor actually underperforms the very fund they own. Why? Because they panic sell at the bottom of a crash, and they buy back in at the top when the news tells them it's safe. Sam's ultimate edge over Ryan was never intelligence. His edge was emotional control, the ability to do absolutely nothing while his stomach screamed at him to do something. The finish line and the 5% rule. Let's jump to the finish line. Year 20. Sam never became an expert. He never learned to read a stock chart. He just kept buying his boring index fund every month and refusing to flinch during recessions. His account is now sitting somewhere around $340,000. He only put in about $78,000 of his own money. The rest, over $250,000, is pure compounding. Money that materialized out of thin air simply because he left it alone. Ryan? 20 years in, the overwhelming statistical odds say he stopped trading 15 years ago.
He blew up an account, got burned out, and went back to a normal life. If Ryan had just put his starting $30,000 into Sam's boring fun on day one, he would have exactly what Sam has, except he would have 10,000 hours of his life back. Now, does day trading ever make sense? Yes, in very narrow windows. If you're at a proprietary trading desk where it's a salaried job, or if you use what I call the 5% rule. If you want the thrill, take 5% of your net worth, money you are genuinely willing to set on fire, the same way you spend money at a casino or on a golf trip, and trade with that. Keep the adrenaline away from the money that decides your retirement. But notice who the real winner of this entire video is. It's the guy who sold Ryan the $1,500 course in year one. He is making money hand over fist, but his edge isn't the stock market. His edge is you. The real trap was never day trading versus index funds. The real trap was believing that the effort you put in has to match the money you get out. In investing, that relationship is entirely backwards. The market does not hand out prizes for trying hard. It hands them out for being right and patient. And patience looks an awful lot like laziness, right up until the exact moment it looks like genius. The next time someone shows you a trading screenshot, don't ask them how much money they made. Ask them how many hours of their life it cost them. Because the guy who did nothing was paid in the one currency day traders always forget to track, the time they never get back. Thank you for watching. If you want to learn more about the boring math that actually makes you wealthy, hit subscribe, and I'll see you in the next one.